Two Canadians. Both earn $150,000 this year. One pays $58,000 in tax. The other pays $13,500 in tax. Same country, same income, same year. How is that possible? It's not a loophole. It's not a gray area. It's not illegal. It's the Canadian tax system working exactly as it was designed, just not for the person earning a salary. Here's the reality most Canadians never learn. In 2026, a Canadian employee earning $150,000 in Ontario faces a combined federal and provincial marginal tax rate of approximately 53.53% on every dollar earned above $220,000, and an effective rate that leaves them with roughly $92,000 after tax on a $150,000 income. A Canadian-controlled private corporation earning that same $150,000 in active business income pays a combined federal and small business corporate tax rate of just 9% federally, and combined rates as low as 11% to 12.2% in most provinces, on the first $500,000 of income. Same $150,000. Completely different tax bill. The tax code in Canada was not built to be neutral. It was built with rules that reward specific behaviors, incorporation, investment, ownership, and penalize others. Specifically, it penalizes earning a paycheck. And the people who understand those rules, who structure their financial lives around them, pay a fraction of what everyone else pays and keep dramatically more of what they earn. This video is about those rules, and by the end of it, you'll understand exactly why the system is built the way it is, and what you can legally do about it. Let's start with the most important thing to understand about the Canadian tax system. Employment income, the money you earn by trading your time for a paycheck, is taxed at the highest possible rate under the Canadian tax code. There is no income type that is taxed more heavily. Here's what that looks like with real 2026 numbers. Canada uses a progressive federal tax system. In 2026, the federal rates are 14% on the first $57,375, 20.5% on $57,375 to $114,750, 26% on $114,750 to $158,519, 29% on $158,519 to $220,000, 33% on income above $220,000. But here's the part most Canadians don't fully grasp. Provincial tax is added on top of federal tax. In Ontario in 2026, the combined top marginal rate on employment income is 53.53%. In Nova Scotia, it's 54%. In British Columbia, it's 53.50%. That means a Canadian earning $220,000 or more in Ontario loses over 53 cents of every additional dollar earned to tax. For an everyday earner, someone making $80,000 in Ontario, the combined federal and provincial effective tax rate lands at approximately 28 to 32% of gross income. On $80,000, that's $22,000 to $26,000 paid in income tax alone, before CPP contributions, EI premiums, and any other deductions. And here's the part the tax system doesn't advertise. Employees pay tax before they spend a single dollar. The government takes its share first. What remains is what you live on. Business owners and investors, by contrast, earn money, then deduct legitimate expenses, then pay tax on what's left. The order of operations is completely different. And that difference is worth tens of thousands of dollars a year. Your action step: calculate your real effective tax rate this year. Take your total taxes paid divided by gross income. Most Canadians are shocked when they see the actual number. Now let's talk about the rate that wealthy Canadians actually pay, and why it changes the entire financial equation. In Canada, a Canadian-controlled private corporation, CCPC, a corporation owned by Canadian residents, qualifies for the Small Business Deduction, SBD. This deduction reduces the federal corporate tax rate on the first $500,000 of active business income from the general 15% rate down to just 9%. Compare that to an Ontario employee earning $150,000 who pays a combined effective rate of approximately 38.5%. A corporation earning the same $150,000 in Ontario pays 12.2%. That's a difference of 26.3 percentage points on the same dollar amount. On $150,000 of income, the corporation pays approximately $18,300 in tax. The employee pays approximately $57,750. That's $39,450 more in tax, just because of how the income is structured. And the small business deduction limit was just increased to $600,000 in Prince Edward Island and Saskatchewan as of July 2025, and to $700,000 in Nova Scotia as of April 2025, meaning the window for this advantage is getting wider in several provinces. Here's the critical concept. The money saved by not paying that extra $39,450 in tax stays inside the corporation. It can be reinvested. It can be used to buy assets. It compounds at the corporation's lower tax rate, building wealth years ahead of what an employee on the same income can achieve. This is not a secret strategy of the ultra-rich. It's a legally structured advantage built directly into the Canadian tax code, available to anyone who incorporates. Your action step. Research whether incorporating makes financial sense for your income level. The general threshold where incorporation starts to pay off is around $50,000 to $60,000 in self-employment income, after personal living expenses. Here is where the tax system's bias toward business ownership becomes most visible in everyday life. Business owners in Canada can deduct legitimate business expenses from their taxable income before paying tax. Employees cannot. Full stop. This is not a minor distinction. It changes the real cost of almost everything. Here's what a Canadian business owner can legally deduct in 2026, according to the CRA Home Office. If you work from home and the space is used regularly and exclusively for business, you can deduct a prorated portion of rent or mortgage interest, utilities, heating, property taxes, home insurance, and internet. The deduction is calculated based on square footage used for business relative to total home size. Vehicle expenses, 100% of fuel, insurance, repairs, maintenance, licensing, and parking are deductible, proportional to business use. The CRA requires a mileage log. For a vehicle driven 70% for business, 70% of all vehicle costs become pre-tax business expenses. Meals and entertainment. 50% of business-related meals and client entertainment are deductible. CRA Rules 2026. Equipment and technology. Laptops, phones, software subscriptions, office equipment, fully deductible as operating expenses. Professional development. Courses, seminars, books, coaching, and subscriptions directly related to business, fully deductible. Professional fees. Accounting, legal, consulting, 100% deductible. Capital assets. The immediate expensing incentive allows eligible businesses to write off up to $1.5 million in capital asset purchases immediately. rather than depreciating them over years. Now here's what this means in practice. An employee spending $800 a month on a car does so with after-tax dollars. At a 40% effective rate, they need to earn approximately $1,333 before tax to have $800 after tax to spend on that car. A business owner spending $800 a month on a vehicle used for business deducts it as a business expense, paying tax on income that's already been reduced by $800. At a 12.2% corporate rate, that deduction costs them roughly $98 in lost tax instead of $533 in personal tax. Same car, same cost, completely different after-tax reality. Your action step: list every expense in your life that could have a legitimate business purpose if you were incorporated. The list is usually longer than people expect. Here is the most deliberately designed advantage in the Canadian tax system, and it exclusively benefits people who own assets. In Canada, capital gains are taxed at half the rate of employment income. Here's how it works. When you sell an investment, a stock, a rental property, a business, for more than you paid, the profit is called a capital gain. The CRA taxes only 50% of that gain as income. The other 50% is completely tax-free. So if you buy a stock for $100,000 and sell it for $200,000, you have a $100,000 capital gain. Only $50,000 gets added to your taxable income. At Ontario's top marginal rate of 53.53%, the effective capital gains rate is approximately 26.76%, according to KPMG's 2026 Combined Top Marginal Tax Rate Table. Now compare that to employment income at the same level, taxed at 53.53%. A dollar earned through capital gains costs half the tax of a dollar earned by working. The Lifetime Capital Gains Exemption, LCGE, makes it even more dramatic. In 2026, qualified small business owners can shelter up to $1,250,000 in capital gains from the sale of qualifying small business shares, completely tax-free. At Ontario's top rate and a 50% inclusion, that exemption is worth approximately $337,875 in tax savings on a single transaction. According to Insight CPA's 2026 analysis. And inside a TFSA, capital gains don't exist at all. Zero. None. A $200,000 gain on stocks held in your TFSA triggers no capital gains tax, no reporting, and no CRA involvement whatsoever. The government's own registered account structure makes investment income completely invisible to the tax system for anyone willing to use it. The people who understand this don't earn less. They simply earn differently. Your action step: move your long-term investments inside your TFSA. Any capital gain inside a TFSA is 100% yours. No inclusion, no marginal rate, nothing. Here's the one powerful tax tool the system offers equally to employees and business owners, and most Canadians use it far below its potential. The Registered Retirement Savings Plan, RRSP. Every dollar you contribute to your RRSP reduces your taxable income by that same dollar. The government gives you back the tax you would have paid on that money immediately as a refund. In 2026, the RRSP annual contribution limit is the lesser of 18% of your prior year's earned income, or $32,490. Contributing the maximum $32,490 at a $100,000 income generates a refund of approximately $13,970. Money the government literally hands back to you for saving. and the RRSP deduction is most powerful when you're in a high bracket, and you plan to withdraw in a lower bracket in retirement. You defer tax now at 43% and pay it back later at 20% or 25%. That spread is permanent, compounded wealth. The RRSP contribution deadline for the 2025 tax year was March 2nd, 2026. If you missed it, your 2026 contributions will apply to next year's return. Unused room carries forward indefinitely. Check your MyCRA account for your exact limit. Combined with the TFSA, this means any Canadian earning employment income has two legal tools to dramatically reduce their annual tax bill. Business owners have both of these, plus the corporate structure advantages above. Your action step: log into CRA My Account and check your exact RRSP contribution room. If you have unused room, filling it is one of the highest guaranteed return moves available in the tax system. Now, let's put it all together, because this is where the real advantage becomes clear. The wealthy in Canada don't use one tax strategy. They layer them. And the result is a combined tax efficiency that the average employee simply cannot access without restructuring how they earn. Here's what a high-income Canadian who understands the tax system actually does in 2026. Step 1. They incorporate. By operating through a CCPC, they immediately reduce their active business income tax rate from 38 to 53% down to 9 to 12.2%, saving tens of thousands annually on the same income. Step 2. They deduct everything legitimate: home office, vehicle, equipment, professional development, meals, software. Every deductible expense reduces taxable corporate income before the 9% rate is even applied. On $150,000 of gross revenue with $40,000 in legitimate deductions, they're paying 12.2% on $110,000, not on $150,000. Step 3. They pay themselves strategically. Rather than paying a full salary from the corporation, which triggers personal income tax, wealthy business owners often pay themselves a combination of salary and dividends. In 2026, eligible dividends from a corporation are taxed at a significantly lower rate than salary. The combined Ontario rate on eligible dividends at the top bracket is 39.34%, KPMG 2026. Versus 53.53% on employment income. Step 4. They invest inside the corporation. Profits left inside the corporation after the 9% tax can be invested in stocks, ETFs, and other assets, growing at the corporate rate before personal withdrawal. This creates a tax deferral, money compounding at the corporation's low rate instead of being exposed to personal tax immediately. Step 5. They use every registered account available. TFSA maxed, $7,000 annually, all growth tax-free forever. RRSP maxed, up to $32,490 in 2026, all contributions reducing taxable income now. FHSA, if eligible, $8,000 annually, double tax advantage. Step 6. They realize income as capital gains when selling. When it's time to exit, to sell the business or the investments, they structure the transaction to trigger capital gains rather than income. At a 50% inclusion rate and the lifetime capital gains exemption sheltering up to $1,250,000, the tax bill on a major exit can be dramatically reduced or nearly eliminated. The result? A business owner using all 6 steps can legally pay effective tax rates of 15 to 25% on the same gross income that an employee pays 35 to 53% on. That gap, compounded over 20 or 30 years, is the difference between financial stress and financial freedom. Your action step: talk to a Canadian accountant about whether incorporation makes sense for your income. The conversation costs less than 1 year of unnecessary overpayment. Let's come back to where we started. Two Canadians. Both earn $150,000. One pays $58,000 in tax. The other pays $13,500. Now you know exactly how. The employee earned a salary, the highest taxed income type in the Canadian Code. The business owner incorporated, deducted legitimate expenses, paid themselves a combination of salary and dividends, and invested the after-tax surplus inside the corporation at a 9% rate. Neither of them did anything illegal. Neither of them used a loophole. They simply understood different parts of the same tax code. Here's what the numbers mean over time. The $39,450 saved annually by the business owner, if invested in an S&P 500 ETF inside a TFSA at 8% annual return, becomes nearly $5 million in year 30 from the tax savings alone. Not from earning more, from paying less of what was already being earned. The Canadian tax code is complex by design. It has 3,000-plus pages of rules, exemptions, deductions, and credits. Most of them were not written for employees. They were written for business owners, investors, and asset holders. Understanding that is not cynical. It's strategic. The people who use the CCPC structure maximize their TFSA and RRSP, earn income as capital gains where possible, and deduct legitimate business expenses are not cheating. They are following the system exactly as the government designed it, and keeping dramatically more of what they earn. You now understand the system. The question is, what are you going to do with that knowledge?